Hello and welcome to Market Outlook. This is Jeff Bish, president of MarketGauge.com, and I'm filling in for Keith this week. So the format may be a little different, but the objective is the same, which is to try and give you an idea of which way the market may move this week and even in the coming weeks based on a number of different factors. So I'm going to start with the four, or really in this case, the three major equity indexes in much the same way I do for our members in our members trade plan videos that we put out each week. And then I'm going to drill down into our market internals, and then we're going to take a look at a whole host of sectors and how the sectors have kind of gone through a transition from the summer until now in terms of the shift in leadership. All right, so before I get started, if you're just finding this on YouTube, please subscribe and make sure you like it. If you're just finding it on Facebook, please like it as well. And also, if you're just finding us, know that we put this out every week, and you can find it at marketgauge.com/outlook. All right, so the markets are really set up in a way right now that they could break either way. And while the commentary leading up to this video did suggest that we have a negative bias in October, it really doesn't mean that the markets have to go down in October, and how far they go down is still left to question. So let's take a look at how we'll know when the markets, or how we should know when we should expect the markets to go down. And until then, well, I think the trend is still up, but questionable. And here's why. So I'm looking at the SPYs in the upper left, the Qs in the upper right, and the IWMs in the lower right. Now, normally I would also look at the Dow in the lower left, but I am going to point out the junk ETF because I think this is a really good way to keep your finger on the pulse of the potential effect of interest rates. And I know Keith goes over this with you weekly as well. So here's how I think you can break the markets down in a really straightforward way. The blue line here is a 50-day moving average. The green line is a 200-day moving average. The magenta line is the 10-day moving average. And what's really the critical line right now is the 50-day moving average. Because if we look at the SPYs broke down below the 50-day, but they were not able to continue lower. And then they rallied back up to the 50 and then started to break down again, but didn't make any headway on the downside. Now that leaves us with the SPYs that, for all intents and purposes, are pretty much stuck in this existing range. And not coincidentally, if we go back left, the high of this range has really been an important level for months, for the whole summer. So if I was only looking at the SPYs, I would say that we're neutral. All right? When we break below this level, we're bearish. When we break above this level, we're bullish. Now, I would call that neutral. However, overall, I think we have to remain on the bullish side of this market, and here's why. The Qs also broke down, but they didn't break their 50, and they came right back up to new highs. So the Qs have a different range that they're stuck in, which goes from up here to pretty much down around the 117 level, right around the 50-day moving average. But the bigger level is this 116 level. So for the Qs, I would say that until we break down below the 116 level, we have to remain bullish. If we break out to new highs, that makes us even more bullish. All right. Now, this is supported by similar action in IWMs if we look down in the lower right. So IWMs had a really significant level around the 124 level. They broke down but held their 50-day just like the Qs did and rallied right back up to the new high area, although not really making a convincing new high. So they have remained also in a strong uptrend relative to their 50-day moving average. So if we've got 2 out of these 3 in a strong trend, strong bullish phase, I think you have to go with the 2 out of the 3, and we've got really clear levels on the downside to switch that bias. Now the downside floor for me in the IWM is going to be around the 122 level. All right, so until IWMs break the 122, I think you need to remain bullish on IWMs. So that brings in junk. All right, we can look at these 3 stock indexes and say, as we should, that we'll really turn bearish if they all start breaking down through their floors. Until they break out of these ranges that they're in, we're kind of neutral to bullish. If they break out to the upside, we're bullish. Now, one of the things we would like to see happen to confirm either of these moves, on the bullish side, we'd like to see the junk continue to move higher. All right, so if that moves higher, that would be supportive of stocks. If it moves lower, below this 36 level, then that would suggest that stocks are probably also going to be in trouble, although they don't have to be. But if the junk breaks down below here and stocks are breaking down, that would be the most bearish scenario. So that's an easy first cut. So now let's take a look at the market internals and industry groups and see if we can peel this onion one layer deeper to figure out which way the markets are likely to go, and if they do break these ranges, what's the likelihood that they'll continue to go higher. And so if we take a look at the free area of the site, our little big view area, and I'm going to start in little big view at the market overview section. Keith does this for you each week as well. I want to focus your attention on this page to the accumulation distribution table down here. Over the last couple of weeks, this has really shifted from having the majority of the days be in the distribution column to now the majority of the days are in the accumulation column. So this should be, and actually has been, a bullish bias or a bullish indication. Now it hasn't been bullish enough to really get all the indexes going, but you can see that the NASDAQ 100's got 3. And what you really want to look for is 4 or 5 in these, in one side or the other, to start leaning that way. But you can see we've got 4 in the diamonds, 4 in the Russell, and 3 in the NASDAQ. So this is mildly bullish, and if the markets continue to move higher, you want to see these numbers continue to stay high. If the markets don't go anywhere and you see the distribution numbers creeping up, then there's a good chance we'll start heading down towards the lower end of the range. So let's dig down into some more of the market internals before I get into the sector part of this story. So if we take a look at the advances and declines, we're going to find that, and I like to look at these in a really simplistic way, and that simplistic way is quite simply, if we're not at an extreme, or we're not really trending one way or the other on all of these charts, I wouldn't put too much weight on it. I don't like to overanalyze it. And in each one of these cases, whether we're looking at the up-down volume ratio or the McClellan oscillator or even the 10-day sum of advanced declines, none of them are overbought. I might argue that at least this is trending somewhat to the upside, but with the other ones kind of in the middle of nowhere, from a market breadth point of view, I would say we're neither oversold nor overbought, and that doesn't really help our case to say which way the market might go, but it does suggest that the market could go either way without having to worry about being overbought or oversold. So in other words, if the market was at a high, well, let's just say if the market were to break out, it's not breaking out from an overbought situation, and that gives it some room to run. And so that's the case on in the New York indexes. You're also going to find that to be the case when you go to the NASDAQ, right? So here's NASDAQ's view, looks pretty much the same, flat line, not in an extreme, even though the index is broken out to new highs. So this would suggest that if the market wanted to go higher, it certainly could. It's not overbought in this measure. So if we take a look at the new high and new lows, these, if there was going to be a warning in the market internals, might be the first place that it starts to show up. And the reason for that is when this line comes down under the 70 level, it's a warning sign. All right. Now, you want to watch this line to be not only crossing under the 70, but continuing to trend lower. The fact that it's turned back up and back over the 70 is now back into bullish. However, we really want to see the total number of new highs as this works its way higher be over 100. All right, so the warning sign here really is, and if we look out and project, what the bears would like to see is that this rolls over. That would probably pull this down. More importantly, you'd want to watch to see if your new lows, your new 52-week lows, started to balloon, or I don't know about balloon, but started to rise. The reason that would be concerning is because on this attempt to move higher here, the new highs really haven't been all that strong. We've had one good day that was solidly over 100. You can see just from recent history, this is a pretty good example of what a decent market looks like as it's working its way higher, right? Not this, right? It certainly, couple of good days, or if it starts to move higher, it's in the territory where it could easily push the new highs into bullish territory, but it hasn't happened yet. So in fact, if you're subscribed to our Twitter feeds at Market Gauge, which is where I will post this chart. At least recently I've been posting this chart to keep people up to date, because I think this is really a simple but important indicator in terms of the health of the move higher. So if we take a look at the same view on the Qs, we'll see that it is, wrong chart, we'll see that it is very much the same picture in that it really hasn't been able to push over this 100 level. The breakdown here rebounded without the market moving lower, and in all these cases, the trade is not based on this. The trade would be based on the market breaking down, but you're going to believe the breakdown if it happens with a lot more conviction if these numbers down here confirm it. All right. So far, as I just said, the breakout is not a complete divergence from the new highs, but we'd like to see more new highs show up if the market's going to continue to move higher. And if more new highs show up and the breakout continues, that would be, I would say, a very strong bullish sign. In terms of market volatility or sentiment, this too is really stuck right in the middle. Now, stuck right in the middle as the market is sitting right under its 50-day moving average suggests, just like I said with the advanced declines, that this market really could go in either direction without worrying about fighting an overbought or an oversold level in terms of its market sentiment. And that view is echoed here in this other measure of our volatility or market sentiment area. In order for this to turn bearish, you really want to see these lines roll back down under this 1.2 level and have the market price break down. If the market price breaks out and this gets pushed up to the upper end of this band, it can stay at that upper end of the band. What we don't want to see is it rolling over with the market rolling over. All right, so from a market internals standpoint, there really isn't a whole lot there that's going to give us any confidence that the market's either too extended on the upside, and certainly it's not extended on the downside. So that leads us to the sectors or the sector summary. So if we take a look at the sector summary, I want to focus your attention. If you've been watching this table for any length of time, you know that not too long ago, these were all bullish phases. So when the background is highlighted, it means the phase has changed. So you can see that we've got a couple new phase changes to warning on Friday, one back into bullish, but it's not all bullish anymore. So that could be construed as somewhat scary, but before we get too concerned about it, let's just take a look at the summation of the 6-month of the industry groups that are in a bullish condition or a positive percent change over the last 6 months. Now you can see up here that we've got all but 2, right? So that's still very strong. And to see how that really plays out over time, just take a look at this chart down here, and you can also scroll down and see it more historically. But the essence of this is that majority of the sectors, which if we sum it all up, we get 12 out of the 14 from that table up above, are positive. When it's this positive, sell-offs are typically a opportunity. The one stopgap measure we have with this indicator is that if you drop under the 200-day moving average right here, then that is so potentially negative that even if you've got positive sectors, you'd want to take a cautious stance. But as you saw in this case, right back over the 200. Now this was Brexit, in an environment of strong breadth of sector numbers, is one which you want to be bullish. So even though I have said that the market takes on a bearish bias in a significant way, if it breaks below this level, we're still on a sector basis in a strong condition. Now that doesn't mean that we couldn't find our way down to the 200-day moving average, and maybe that's the bearish October move. However, if we get down to that 200 and the sectors seem to remain bullish, then that's probably a buying opportunity more than a selling opportunity. But that's really running ahead of where the market is right now, and I'm certainly not suggesting that I think we're going to go to the 200 this week. The important thing here is that this is high, and that suggests we should find some good support in the market right now. So that's looking at it from kind of a 50,000 foot view. Let's take a look now at how the market has really rotated over the course of the last few months through these sectors. Now, one of the easiest ways to do this from a charting point of view is using our triple play indicators. Now, it just so happens I just did a live webinar on the triple play indicators and the power of understanding price leadership. So in this case, or for this video, I'm going to take a look at the sectors in the triple play view. Now, I'm going to start really quickly with what we refer to as the modern family. If you don't already get it, make sure that you sign up for Mish's Daily. It's a analysis that Mish puts out every day, and she really focuses your attention on which way the markets may move based on what her modern family is doing. Now, her modern family is 5 sectors and the IWM, and the sectors are XRT for retail, IBB for biotech, IWM for a broad measure of the stocks, SMH for semiconductors / technology, and IYT for transportation, and KRE for financials. Right, so that gives you a very good broad measure of what the market's doing. I'm going to go a little bit more than that. I want to take you through what I've described as kind of the rotation that has happened in the market. So I'm going to change these charts And what I want you to focus on as I'm describing what has happened is this top indicator here. So this top indicator here is a price leadership indicator. Very simply put, if the blue line, which is a short-term measure of the strength of the market, is over the red line, which is a more intermediate term measure, it means that that particular market, ETF or stock, has good leadership. It means it's in a strong trend, a trend that's most likely stronger than the market, either on the way up or on the way down. Now, the black line is an even longer measure of that leadership. So if we're over the black line as well, it means that the longer term trend is even more intact. So at its simplest interpretation, blue line over the red line is bullish, blue line under the red line is bearish, because it means that that particular instrument is either leading or on the upside or leading on the downside, depending on bullish or bearish. All right, so if we go back to kind of the higher, I'll say high, if we look at the beginning of the summer and we think about what was leading and doing well at that time, the XLUs, the utilities, were doing quite well. In fact, they were one of the leading groups. A little concerning for a strong bull market or a bull market. But you had your XLU, which was leading. You had XLPs, which were leading. And you had IYRs. All right. I'm going to leave IWM as our proxy for the market right here. Let's do that. So, and you had IYR, which was also leading. Now, what I want to point out here is that as these were in nice, strong uptrends, and so was the market coming off of Brexit. But once the Brexit glow kind of wore off, the market started to rotate. And you can see that rotation with the XLUs breaking down on their triple play leadership line. And that triple play leadership line remained negative all the way into just kind of recently in the beginning of September. And that was also true of the XLPs. So the XLPs, which ran up nicely after Brexit, also kind of broke down here and broke down, and these have not recovered. And then finally, IYR, same thing, kind of broke down before the price peaked out, then the price peaks out, and the breakdown becomes more pronounced, and these things really look like they're in trouble. Now, this would make sense, right? Because this is all of these could be construed as defensive, although in the media and for real, they were probably rallying because people were chasing yield, at least for XLU and XLP, all right? And IYR. XLP, maybe some yield there, but also some safety. Now, when that started to roll over, what started to take over? Well, what started to take over around that same time were technology started to move. Right, so notice that in July here, when I just was pointing out the others were starting to roll over, XLK technology really started to take off. Now that has remained a strong leader. Now that's in large part because SMH, a subsector of that, in July really took off and has also maintained its leadership, and in a big way you can see still maintains its leadership. So if there was going to be an argument or a place to look for the market to continue its leadership, that certainly would be it. Now the other place that started to show some leadership, which was welcomed, were the financials. All right, so I've got the Vanguard VFH here. We used to focus on XLF, but because of the split of real estate out of it, TradeStation's data is all messed up. Can't get history on it. But the VFH actually tracks similar stocks. And you can see that in July, this thing started on its leadership indicate that it was positive on leadership, and it had a nice run. Now recently, however, this is where it gets interesting. Financials started to get weak in terms of the leadership, and they've pulled back. And now this has also been the case with biotechs. So biotechs, if we look at them in terms of IBB, started to show some strength in July, had a nice run, and then got a little shaky. Got a little shaky towards August. In September, started to come back in terms of their leadership. Now, IBB, and if you've been to our free trainings, certainly anyone that I've done, you know that I've been on top of IBB because this breakout above this base level and now the breakout over 300 would really be a significant breakout. So IBB is questionable right now, but September it started to resume its leadership. Now, just like XLF, they were a leader, they started to fade. Now in this case, IBB's come back. I want to focus your attention, however, on the other biotech index, XBI, which has remained stronger, and its trend has been stronger, and its leadership indicator is stronger. So this, as long as this stays above this 64 level, to me suggests that biotech still is an area we should be looking for leadership in right now. The same thing is true of KRE. So we've got KRE is the other financials, regional banks instead of the bigger banks, and that too turned up in July, but has now come under a little pressure in terms of its leadership towards the end of September. However, this one is in a really good position to turn back higher. And its chart, if it can stay over, or I should say get over the 42 level and start to move higher, is in a great position to resume its leadership. Right, so we've got the one segment of the financials, the KRE, which if they continue to move higher could resume leadership. We've got the XBI and the IBB that if that turns higher, it will resume its leadership. They've been under a little pressure recently, but they could resume it. Now, it's a similar story for IYT, all right, the transportations. So transportations also started off in July looking like they might turn up, but then they struggled for a long time in terms of just price action as well as leadership. But if you take a look at XLK, let me pull this up. I think this is an area of the market you really want to focus on over the coming, certainly over the coming week if it moves higher. And this is why. Look at the pattern in XLK as it broke. As it broke out of this, I'm going to say massive kind of base or top. If you look at how the leadership really explodes higher as the breakout occurs, that's the kind of breakout that you want to follow. That's the kind of breakout that's going to continue. That's one of the powerful aspects of the leadership indicator. Now let's take a look at what's going on with IYT right now. It's got a very similar long multi-month consolidation that if it breaks out of, represents a significant breakout. It also has its leadership line, which is turning over, the red's beginning to cross over the black, and if this breaks out, you're probably going to see this blue really accelerate over the red. If that happens, that's an indication that transportation could be getting a new leg up. If we can get transportation to participate in such a healthy way with a market breakout, that would be very bullish. If that corresponds with a KRE and a XBI or IBB moving higher, now we would have several key sectors in addition to the technology sector participating on the upside. And that's exactly what the bulls need to see. So that may sound like I'm pounding the table saying the market's bullish and it's going to break out and move higher. It's not what I'm saying, but what I am saying is that if the market breaks out, and this could be as soon as this week, and you see the transportations breaking out, and you see the KREs moving higher, and you see the IBBs moving higher, you've got a solid group of sectors that could really power this market higher, even if the one I didn't mention yet, and the problem child here, XRT, the retail area, doesn't improve. Now, the thing to look at on the XRT is the fact that while its leadership line has broken down, this was one that really started to look good in July as the XLU and XLP and IYR were breaking down. Retail was starting to look good, but it peaked out in the middle of the summer. Its leadership fell apart. It fell apart. And now, from a leadership point of view, it looks quite bearish. That said, from a inflection point of view, remember the green line is the 200. Sitting right on the 200, it tried to break down. Friday, it reversed. That's only 2 days of a pattern. It's certainly only one good up day of a pattern. This particular ETF has not been able to close above the 10-day and then really move higher in a significant way. Now, if you are a member of either the triple play or the trading essentials, or really almost any other of the member areas that I do the mentoring videos for, you know that pattern over the closing over the 10 and moving higher is one I really like to rely on. And when you haven't had that in such a long time, and then it happens after a breakdown that fails, it's something you really want to pay attention to. Now, if the triple play were to move higher, then it would really be convincing that this inflection point is once again potentially a turning point. Now, if we could get that going on the upside, then we really know the bull market's got something to take off with. So keep an eye on that XRT. Don't let the XRT get you down if it doesn't take off right away, if you've got those other indexes moving higher. But also watch the XRT, because if it continues to break down to the downside, this is negative, and this here is currently negative. So the negative, if we flip the coin and say, what are the bulls going to look out for, or sorry, what are the bears going to look out for? It would be that XRT breaks down under 43 convincingly and continues, and all these indexes or all these sectors that I'm suggesting are trying to turn, if they turn lower, then the bull case pretty much falls apart. And that's where we look at the markets having a rough October. All right, but the lines are very clear. The ETFs to focus on are very clear. If you've got the triple play, make sure you're looking at it on these sectors. If you want to learn more about the triple play, I'll put a link to the free training. That link will be up for the weekend, so make sure you get it this weekend. And that's all for now. Hope that helps, and we'll see you next week in the next Market Outlook.